Hi, I'm Paula. Welcome back to the channel. Here we talk about the macro stories, the crypto shifts, and the global moves that actually shape this market, without the hype and without the noise. Today, I want to explore something that I think could become one of the biggest stories of the next crypto cycle. It's something that almost no one is explaining properly yet, because most people are still focused on the surface level hype. AI coins pumping, new models launching, tools trending on social media. But underneath all of that, something much bigger is happening. AI is not just influencing crypto from the outside, it's starting to participate in the market itself. And this is the part I don't think the industry has fully grasped. We're entering a stage where AI isn't just a theme, it's becoming an actual liquidity actor. It's interacting with blockchains, reading market data, executing trades, responding to volatility, managing risk, and coordinating flows across multiple ecosystems. That's a structural shift. And if we're right at the beginning of it, then the entire shape of the next crypto cycle could look completely different to anything we've seen before. Let's start with what everybody is seeing on the surface. AI coins are suddenly moving again. Projects like DeepSnitch AI, which is more than just a narrative play, pumped over 70% because real demand is forming around its technology. Not the white paper promised demand we saw in 2021, but actual usage and early adoption. These are systems that analyse data, identify patterns, and generate real-time intelligence. That kind of functionality creates genuine economic activity, not just hype-driven speculation. But the part that most people don't see, alongside AI tokens and protocols, there's a new generation of AI agents being built specifically to operate in financial markets. These agents can read order books faster than any human. They can evaluate risk across 20 different chains simultaneously. They can detect liquidity shifts in seconds. They can monitor sentiment across millions of social posts. They can audit smart contracts, find arbitrage opportunities, and execute trades before most traders have even opened their charts. And they can do all of this around the clock. This means something very simple but very powerful. For the first time ever, crypto is gaining a non-human participant that contributes to liquidity, even when market sentiment is low, even when retail is asleep, even when traders are waiting for CPI print or a Fed meeting. AI fills the gaps. It creates micro liquidity where none existed. It keeps markets moving, and it amplifies trends. When liquidity does return, whether through macro policy shifts, rising risk appetite, or new capital flow in, AI agents accelerate that movement. And this ties directly into macro, because liquidity cycles have always been driven by human psychology. Humans panic slowly, they get euphoric slowly, they hesitate, they wait for confirmation, they second guess themselves. But AI doesn't. When liquidity begins to turn, AI responds instantly. When volatility increases, AI adapts instantly. When opportunities open, AI seizes it instantly. And when risk rises, AI will pull back before most traders realise anything is wrong. This creates a market that moves faster, reacts faster, and reprices faster. In the past, macro liquidity shifts created waves. Now, they will create shock waves. But I want to go a layer deeper, because this isn't just about trading, it's about demand. AI systems need compute, they need access to data, they need execution environments, they need secure rails, and many of those components are moving on-chain. That means tokens are no longer just speculative assets, they're becoming the access keys to computational power, inference engines, and decentralized intelligence networks. That's why we're seeing early infrastructure projects building decentralized compute marketplaces, GPU sharing networks, AI-powered security tools, on-chain reasoning engines, and analysis systems like DeepSnitch. These aren't joke tokens or hype cycles. They're the foundation of what could become the AI economy inside crypto. And real infrastructure attracts real capital. That's why we're seeing early VC interest, quietly without splashy headlines, and why institutional research desks are beginning to explore AI blockchain as a major theme for 2026. This also brings us to something else. AI systems are starting to use blockchains, not just as assets to speculate on, but as tools. They sign transactions, they pay gas, they move stablecoins, they swap liquidity, they take positions in DeFi, they execute arbitrage, they interact with smart contracts. In other words, blockchains are no longer just serving humans. They're serving machines, and machines can generate more consistent activity than retail ever could. Imagine a world where thousands of AI agents are operating at once, executing millions of microtransactions, delivering constant on-chain flow, and creating a balance of activity that doesn't rely on human sentiment. That world is forming now, and it means that the next crypto cycle may not be driven by retail emotions or institutional FOMO, but by structural, mechanistic, algorithm liquidity that accelerates every trend. Ethereum's recent reclaim of the $3,000 after the Fusaka upgrade is a perfect example of timing aligning with structure. The upgrade improved throughput and efficiency, just as the AI system began building on top of Ethereum and its roll-ups. That wasn't hype, that was narrative aligning with infrastructure. Bitcoin fits into this as well. As AI increases market activity, Bitcoin becomes the settlement anchor. It becomes the asset that AI agents move into and out of as volatility shifts. It becomes the liquidity gravity point, especially if global liquidity continues to show early signs of stabilizing or turning. But let's be honest, this isn't without risk. AI can accelerate the upside, but it can also accelerate the downside. Liquidation cascades can happen faster. Mispriced risk can unwind faster. Narrative cycles can flip instantly. And it will expose traders who rely on hope over strategy. This next cycle will reward the disciplined, the informed, and the people who understand how liquidity interacts with technology. So when I say 2026 could be the first AI-driven crypto bull market, I'm not making a prediction based on hype. I'm looking at the structure. AI is becoming a trader. AI is becoming a user. AI is becoming a source of demand. AI is amplifying macro behavior. And all of this is happening right now as global liquidity indicators suggest that the tightening phase may be nearing its end. AI plus crypto plus macro aligning at the same time. That's something we've never seen before. So let me know in the comments, what do you think? Is AI about to reshape the entire market? Or is this narrative still early? I'd love to hear your thoughts. And if you want to connect with a community of people who aren't just reacting to news, but who are actually learning, analysing, and navigating these markets together, join us in the Crypto Wolfpack. It's a space where normal people can trade, learn, ask questions, share charts, and stay grounded through whatever the market throws next. The link is in the description. Thank you so much for watching, and I'll see you in the next one.